As you know, diversification is a buzzword on everyone's lips right now. How are you approaching that in terms of equity allocation?
I'm actually delighted to hear you say it's a buzzword, because we think it's the sort of thing that is probably critically important to how everyone should think about our portfolio. But in many ways, the last 15 years, let's say post global financial crisis, great financial crisis, has been one in which it's paid not to diversify.
Really?
It's been a world where, in fact, if you had perfect foresight, you would have had as much exposure as you possibly could to a small subsection of US equities. I think the thing that we think is of utmost importance in the world today is that the basic building blocks of the multi-asset portfolio, which is how all of us have been saving, really, anyone I think probably born from the 1970s onwards, has experienced a world in which traditional assets have been very diversifying towards each other. In other words, when equities have had a difficult time, bonds have tended to do very well. And that's been the basis of the 60-40 portfolio, and it's worked extraordinarily well. And our concern is that we find ourselves today in a changing global economic and political regime, which is starting to create dynamics that are changing the interaction between traditional assets. And as such, the 60-40 portfolio is no longer as resilient as it once was.